This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
He got a call from a new investor who's clearly like a savvy guy. And at the end of the pretty short phone call, 5-10 minutes, he's like, yeah, I think we can lend X amount, hold this much in construction, and we'll feel, pretty good about the whole deal. He's like, how? You don't even know anything about me. He's like, no, I do. I know about you based on what you're paying for this property, the fact that you know your construction, you know your resale value, you have a bunch of rentals with bank financing, which means you have good credit. So I know a lot more about you than you think. And the guy was like, oh, wow.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. We're now in the throes of a technical recession. And while banks are still lending on certain deals, overall financing has tightened up. Now, this means that non-traditional lenders are now the ones to really talk to about getting deals closed. It becomes very important to have relationships with those types of folks. Now, today's guest is a specialist at doing this type of lending. He began his career in real estate finance with a large commercial bank where he learned the business of lending, real estate, and personal and commercial finance. Now, with this base of knowledge, he combined it with his entrepreneurial spirit that led him to really co-found a private money platform in 2007 and quickly grew that platform to 25 million in loan volume back then. Now, he's also the co-author of The Whiteboard, which is the #1 best-selling book as well. So definitely check that out. With all that, I'd like to welcome Chris Haddon to the show. Chris, thanks for coming on, man.
Glad to be here. How are you, Augustino?
I'm doing well.
I'm a fan of the show, and I'm glad to be on it.
Awesome. Happy to hear you. That's good. Now, guys, if you want to be like Chris and subscribe, you should go ahead and do that. And if you like what Chris has to say, reach him via his contact page at hardmoneybankers.com. Okay, Chris, go ahead and tell listeners a little bit about your journey. How did you get started?
Yeah, sure. So I initially got into, like you mentioned some of it on the bio, in lending on residential and commercial real estate back in like 2003, so kind of straight out of college. At the same time, my business partner, Jason, and he and I were friends from high school, ended up back in DC area around the same time. And he was selling some real estate, got into the mortgage world, and we wanted to team up on something real estate related. So we bought a couple rentals, did some flips and wholesales, just very, very 101, like residential real estate stuff. At the same time, the commercial banking, the lending was a good business 101. I knew it wasn't the end of the road for me, but it really was a great place to start in terms of just being exposed to a little bit of everything in terms of finance and real estate. During that time, we actually borrowed from a hard money lender on a couple rehabs that we were doing around Philly. And a lot of other people have this story too, but we ended up doing okay on those, especially during that time in the market and that like 04, 05, 06, like lead up to the big drop, which we'll get to as well. It touched everybody. And we realized that after doing all that work on a resi rehab deal, like fix and flip sort of thing, that lender probably ended up making as much as we did, and we were fine on it, but he didn't have to do very much work. And so we noticed that. And also we both had the lending background, and we always felt like we were more effective at running a lending company and everything that goes into it, more so than the property specific stuff, the construction, the design. I wasn't great at that then, and I'm not great at it now. So at a very interesting time in the market, so it would have been, we closed our first loan 15 years ago this month.
Oh, wow.
It was
nice.
December 2007.
Congratulations. It's awesome.
Yeah, thank you. Yeah, we just had a fun holiday dinner, HMB 15, all that. It was very cool. it was a very sticky time in the market. Everything was crashing. And granted, different problems that we have now, but we see some similar things happening. Obviously, a big problem at that time was how aggressive residential real estate finance got with all the subprime and all the over-levered stuff and unqualified borrowers, which led to that residential foreclosure situation, right? That like played out over a number of years. But it was very interesting when we got in. I mean, we were young at the time, we were 27, 28. And I got the side of our business in charge of raising capital in that environment. Like everyone is terrified of what was going on, especially in investment real estate. And I'm like, hey, invest with HMB, right? We're going to do some great loans, which was the case because there was so little liquidity in the market that we had our just coming onto the scene at the first time. A lot of our competition had gotten their capital disrupted, especially if they were using some institutional sources, or they just took hits on risky loans that kind of put them in. So we came in as the next generation, in essence, like us being in our 20s. A lot of our competition here in DC and Baltimore is where we were lending at the time. They were, our parents' age. They were like people in their 50s who had been around for a while. And yeah, it was super interesting how everything developed because all the web marketing and that stuff was just coming on. Like email marketing was around. SEO was way different. Google AdWords was new, right? Stuff like that. A lot of our competition it was very mom and pop. They didn't have websites yet, nothing like that. And now it's kind of funny because looking back, like we're turning into the old guys and there's a generation behind us. So anyway, yeah, we were the next generation coming around and we did it very web and tech style because that was just part of our generation. We were kind of being that age right in between that old school business from like 80s and 90s and now, right? So very interesting time in the market. We started growing pretty quickly. Not that raising capital was easy, but we put it together, and a lot of our capital base has been with us for, a decade or more now. A lot of the same people, and it's like grown slowly over time. Now we have about 50 million outstanding in the loan portfolio, plus some equity stuff too. And at the beginning, it was growing. It was like double. And that doesn't last forever. You become a mature company and like kind of level out a little bit and grow slowly. But during that like double phase, we were just very intent on not screwing it up, right? Like we're growing. We're like at first doing everything ourselves, obviously, just like any startup situation, working out of the back of a title company for like $500 a month rent or something like that. It was interesting times. And we started hiring people slowly and carefully. And the portfolio went up to, maybe in the first like 5 years, we got up to 20 million or something like that. It was still early on. And then we got a bit of the entrepreneurial ADD, the shiny object syndrome.
Yeah.
As we had more of a team, we moved to the office where we are now. There's one or two in between, but to the office where we are now, and started trying to do everything under the sun, right? Like we were, maybe early 30s at the time, putting out a book or two, buying rentals, launching some website stuff and some info products, and just kind of like everything we could do. And it's interesting that season of business, right? Because it's great from a learning perspective, but at the same time, as you grow up a little bit, you focus back on what really brings in the bottom line, right? Instead of the shiny objects, you kind of refocus and double down on what you're best at. And so that process for us, which is continuing now, I mean, I think it continues forever, has been, especially in the past 5 years, granted there's a pandemic mixed in, which made things a little weird. But in the past 5-6 years, we've let go of some of the distractions on the side and focused in even more so on what we do best, which is deploy capital and debt and equity and market everything to do so and run the operation that makes that happen. And it's been good. It's like you can do more with less, kind of.
Yeah.
You know what I mean?
Yeah, that's right. Excellent. Well, so it sounds to me like when you first started out, okay, you had you're using single family, or I'm sorry, you're using hard money rather on the single family stuff, and now you're doing it yourself. So maybe go through a very quick description of hard money. What is it, and when do people use it? Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me.
Yeah, sure. So hard money, the term and the little niche has been around for a long time. There's been a push in the industry recently to change it from hard money to private money, which I'm totally fine with, even though we're branded hard money bankers. And that part of the reason why we picked that name is because of search rankings and everything else and just the ease of identifying what we do. But it is a very niche thing, always has been within the giant world of real estate, where people need to borrow from some kind of private capital source. And that's typically going to come with double-digit interest rates and some fees up front. And it's situational. You know, our borrowers, like we have a lot in fix and flip, and then we have a good portion, maybe 25% or so in small balance commercial. They use all kinds of capital sources depending on the situation. They all have bank relationships. A lot of them raise equity. And then if they need some kind of quicker private loan from a company like us, that's in the market too. A lot of property owners never even have to use a private lender like us, but many do. Many do. Sometimes it has to do with speed or some kind of little niche thing, or I got to take this property down and then I'm going to work on my permanent financing. Stuff like that pops up all the time, in addition to the fix and flip, where that tends to be kind of plan A, the financing like ours. Yep. For that niche is oftentimes plan A, and sometimes we're plan B or C, and it's just all part of it. That wasn't that quick of a summary, but
no, but that was good though, because I think many people don't even consider hard money. They think that it's just way too expensive and certainly not cheap by any stretch. But at the same time too, if you're going to use that type of private money, there's got to be a lot of juice available to squeeze out, right? And I think that's the thing. I mean, most people just immediately disqualify it as soon as they hear hard money, like, oh my God, not hard money. But there's a time and a place to actually use it, right? And I think today, these days, is one of those places. Just because, I mean, I'm seeing, for instance, we don't do much in the single family world. We understand it. Obviously, we do more multifamily, but you still have to understand where the competitive forces are. We're seeing deals. Houses, for instance, you know, in a normal C-class type of area might be $100K. That stuff is now, they're trying to unload this stuff for 50% off, $50K in some cases, right? So it's like, if you want to buy all of them, like all of them, sometimes you have to use hard money to close quickly and get the deal done, right?
Yeah. For the longest time, hard money's just had a branding issue. Like in the commercial world, it's called a bridge loan.
Yeah, that's right. That's right.
Well, it's the same thing. It's the same thing. It just sounds way better. Yeah. And so like when sometimes when a potential borrower or broker or something like that approach us, they're like, oh, we're not looking for hard money. We're looking for a bridge loan. And lenders are like, oh, okay. Because we know behind the scenes, it's the same thing.
It's the same thing. Yeah.
It's the same thing, but kind of a branding issue has always been around. It just sounds a little, gangsterish. It's not, but it sounds that way.
Yeah, I think it's part of it is, I remember specifically when we were kids, you'd watch those old movies, and if you didn't pay the gangster guy, you'd come over and break your kneecaps or something like that. Certainly it's not the case. You should always pay your bills, of course, but that's another story. But regardless, absolutely. It's like we use bridge loans all the time to get into a deal, turn the deal around, and then refi. I mean, that is normally how multifamily anyway is done. That's just the course of business, So certainly it's not cheap. Like you said, I mean, there's usually some points up front, but it's great for short-term type scenarios is really what it's great for. So that part is great. So right now you're raising private money from investors, like individuals, it sounds like, right? And then you're bringing them into the fold, and then you're basically selling that money to other folks. Right. So
sort of. We don't really sell anything. So we've been operating different than a lot of our competition for the past 5 or 6 years in that. So we've had the same, few dozen high net worth individuals with us for a long time. And then obviously part of the overall plan and long-term plan is reinvesting our own funds and lending our own. Like that's obviously, the vision for way down the road and currently just, so we haven't actively raised capital in some years because you get to a point where you level off, yet the capital base keeps growing because it's earning interest in the portfolio.
Really
so we typically have more on the sideline that we can deploy. Not typically, always. So we haven't actively raised capital in a long time. And we actually don't sell any notes. Never sold a note. We keep it, service it. Over the past 5 or 6 years with a hot residential market and low interest rates, a bunch of institutional capital jumped into our space that's not normally there. and they were deploying all kinds of money, and it was basically a race to the ground, right? So like trying to deploy billions and doing it cheaper and cheaper and cheaper, to the point that we really did become plan B for a lot of our own clients and other people in the market, right? In the past 6 months, that all changed with rising rates and whatever happens behind the scene in secondary market, securitization, and the price they're paying for that stuff. Long story short, that capital that was around, kind of hot capital, temporary stuff, that was lending out at like 8% or something like that, is now 12 or 13. It's like, okay, we just got a lot more popular, especially in the past 3 or 4 months, than we were in the past 3 or 4 years. And we always maintained and just kind of like steady Eddie is how we refer to our company a lot. But no, we're seeing some bigger deals, better deals, stuff that we might not have won last year that we're closing right now. It's been interesting.
Nice. So now what markets are you guys jumping into right now these days?
So for the most part, we're in the Mid-Atlantic, the 6 states around the Mid-Atlantic region. On commercial stuff, we go outside of that a bit. On self-storage, multifamily, we've done some other markets for sure, both on the debt and equity side.
Nice. Good. So when it comes to, like, say, the single family, for those listeners that are in those types of spots, I know that every single lender is different. They're looking for a certain asset size, leverage, a variety of different things. If it's going to be a flip or whatever, generally speaking, what does your deal look like for an individual that maybe wanted to do a single family, for instance?
Okay. For a single family. So we try to stay in the median housing prices. That's where most of the successful deals happen in that space. High end's a little daunting when it comes to single family, and low end too. The high end and the low end are affected most in a changing market like now. So a lot of our deals are suburban, maybe $350K loan on a property that they're going to put money into, resell it for $550, median housing price for that area, whichever it may be. And investors that are either full-time or part-time. They could do a couple deals a year. They could do 12 or 15 in a full-time sort of thing. And they work with a couple different private lenders like us based on the scenario. A lot of them will resell some, hold some others as rentals, depending on the asset and what the right game plan is. So yeah, that's kind of our cookie cutter bread and butter deal. And then other opportunistic stuff pops up. Like somebody's buying, for example, a self-storage property that we're closing on Friday for 1.2.
Nice.
And plan A didn't work out. So we're coming in with 650 on a 1.2 purchase. So obviously that's a very easy underwrite for us. And it was all they needed as they line up their permanent financing that has some CapEx and everything else. So situational, opportunistic stuff like that comes our way a lot too. If you have private capital, somebody's going to need it for something.
Right. So in the case of that self-storage, it sounds like it's a 50% LTV. For a single-family home, what is it typically there?
65.
Okay. All right.
That's kind of industry standard.
Yeah. Has it changed since this recession has really come into full force?
We're typically a bit more conservative, possibly, than we even need to be.
Okay.
And that's just how we lend and the way we've been doing it. And probably, I'd say early this year, we started seeing the writing on the wall in terms of residential real estate values peaking. And so we dropped LTVs a little bit, bringing more cash. And that's our main pushback from potential borrowers. It's like, I have to bring this much cash. It's like, it's just where we're comfortable, risk-wise. So yes, we have pulled back on that a little bit. We're seeing our buyers get good buy opportunities on resi stuff, but at the same time, they have to be careful, and we have to be careful on the values outstanding in the portfolio. Is that 550K place down to 475? Like, it's very possible.
That's right.
Right. And we're watching all that. We're watching the resales, making sure payoffs are still coming in, which they are, which is a good sign. Refinances are closing, sales are closing. Just all stuff we watch. Just be careful and do more of the same.
Now, I've seen at least development loans come in that low too. So I should say low, like it's like leverage wise. I mean, that's normal in the development world. We do development as well. We had some lenders doing 80% leverage like about a year ago. Now it's down to 65. They kept on ratcheting it down. They retrade us 3 times till they get to 65. I'm like, well, geez, okay, great. So,
I know.
And the same thing's happening. I think the same thing's happening across the board. I mean, it's not really out of the ordinary per se, but certain hard money, there are hard money guys that'll lend higher, but it's because I think it's to your point, it's situational. They understand that home is going to be worth X amount in the future, no matter what happens. Right. Maybe it has a lot to do with the type of market, because I think the markets that you're in they tend to move more, right? I think that in terms of the deals trade on a more frequent basis, and they'll appreciate much faster than, say, in a place like Cleveland, for instance. So we're talking in the green room about appreciating versus cash flow markets. And I would imagine in your markets, the ones that you're going after, those ones appreciate. Even now, they're still over time anyway, they'll come up much quicker than they will in a place like this, for instance, right? I would assume anyway. I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern, and the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. The economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items. Meaning that dollar is losing value, and if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cashflow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So, if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there, these webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cashflow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show.
Yes, they vary though. Like for example, DC and Baltimore, which are only an hour away, are very different markets.
Yeah.
And like DC would be more what you would describe as an appreciating market. It's not going to be the same kind of cash flow on rentals, for example, and the opposite in Baltimore. It's not going to appreciate much, but you can get good cap rates and everything else. And then we're also in Philadelphia, New Jersey, and you just have all different stuff in terms of what's happening in the city versus the suburbs, North Jersey versus South Jersey. So it's basically everything that you mentioned is inside of our mid-Atlantic lending market.
Yeah. So I think understanding as an underwriter, if you're underwriting a deal, understanding that those market dynamics obviously comes into play as well. So the reason why I say that is because as a user of that money, for instance, so who's going to be possibly making a call to you and your team, they really need to understand what type of deal they're getting into, what the end play is, and how to sell it, basically. Like why should you guys want to invest in this deal, so to speak? Because you guys are technically investing in that deal, like that's what a lender does, right?
Sure.
Think about it.
Absolutely. And you can tell a lot from, like, say it's someone we don't know. Obviously, we lend to a lot of the same people over and over. But if it's someone that we haven't done business with yet, you can learn a lot in your initial conversation with them. Like buy price, for example. Are you buying right? If somebody's overpaying, like that's a little hit to the credibility right away. It's like, oh, you're paying $200 in that neighborhood for a full rehab. It's high. Versus if somebody is buying right and does know their construction number. My business partner, Jason, tells a story that he got a call from a new investor who's clearly like a savvy guy. And at the end of the pretty short phone call, 5-10 minutes, he's like, yeah, I think we can lend X amount, hold this much in construction, and we'll feel, pretty good about the whole deal. He's like, how? You don't even know anything about me. He's like, no, I do. I know about you based on what you're paying for this property, the fact that you know your construction, you know your resale value, you have a bunch of rentals with bank financing, which means you have good credit. So I know a lot more about you than you think. And the guy was like, oh, wow. And, after you do 3,000, 3,500 loans, you tend to get kind of good at it.
Yeah. Oh, yeah.
It's the value of spending, 15 years now trying to get as good as we can at one thing with a few things on the side, but at one core thing, you tend to make some progress over time.
Well, yeah, exactly. I mean, I think once you hear the individual on the phone, if they sound like they know what they're talking about, you have some degree of comfort knowing that they're going to perform. They're going to see it through.
Absolutely.
Right. Yeah, absolutely. No, I totally agree. So on the commercial side, the multifamily side, those bridge loans,
Bridge loans.
That's right. Now, what do those deals typically look like? Same sort of leverage, I'm guessing, right?
Yeah, same sort of leverage. It's going to be on a loan to cost model because we don't do construction on multifamily and commercial. So it would usually be either a quick acquisition need or maybe like a cash out bridge loan kind of situation. One of those two. Say the acquisition's more common than a cash need. To take a property down, whatever it may be, and then to line up that permanent financing in like a 3 or 6 month time frame. Could be construction or just permanent. And that's a common use of a bridge loan on some kind of commercial property. We did see a good amount of cash out sort of transactions, especially at the beginning of the pandemic, when a lot of property owners were worried about their cash flow, office, retail, stuff like that. So that kind of came and went a little bit, still happens on occasion. But that's all in the mix. That's all in the mix in terms of the debt stuff. And then during that time too, we learned how to do equity, specifically with a couple operators that we know pretty well, first in multifamily and then later in storage. Also a little office mixed in there too. So that was not too far outside of our wheelhouse, but it was something new. Just like the numbers that you can easily do in your head were different, right? In terms of a lot of your go-to transactions, you already know those numbers. And then you can learn these over here on the equity side. It just functions a little bit different. But with our own capital and also investor capital, we had the capacity to get into that on the right stuff. And then you see some cool things that come through because one of the downsides of the lending model is the taxation, right? Yeah. We're not getting a K1 of depreciation on doing loans. So to mix some of that into the portfolio, owning some of these assets and getting those kinds of benefits was a nice addition to our whole operation.
Nice.
So getting better at that. And we have maybe 10 or 12 equity deals outstanding. A lot of them, the capital's been returned by refinance, especially when those were appreciating. Rates were still low. It was easy in and out, and we were able to stay in for our equity, which has been very cool. Looking at another one, actually a local, not far outside of Baltimore. It was going to close around the end of the year, and I think got pushed back, and that's a multifamily acquisition where we're going to come in with equity for that. We've also done like a kind of debt and equity blend, where we might even do an at-cost loan in exchange for equity. So we've messed around with all of these in the past 3 years, give or take. And it's been good. We're careful, just like we are with everything else. And it's been a very nice addition to the portfolio.
That's nice. It's usually these type of private guys don't do stuff like that, which is interesting. I think you guys have a great deal more flexibility because that's huge, right? If someone an operator really knows what they're talking about and they know that a certain area is depressed for whatever reason, but they know it's going to come back because they have factual data and they can tell you about it and partner up with you guys, so to speak. In exchange for a lower rate, but you guys get equity in a deal. It's perfect. That's beautiful. A lot of not too many people do that kind of stuff. That's the first I've ever heard of it, actually. So that'd be really cool. I mean, I'm sure
it is kind of unusual.
Yeah.
And also we have the flexibility because of the fact that we control our capital.
Right.
And a lot of people have more things on the back end than we do, like selling that out or maybe lines of credit or something like that they just wouldn't have that flexibility to do so. And which is one of the reasons why we've always stayed relatively small.
Yeah.
I mean, yeah, compared to our competition in, 2012, we were big. And compared to our competition, say in 2020, we're small. This is just kind of the way everything moved. But we've always stuck to our main model. I'd rather go steady Eddie and have it be consistent and predictable growing into the future. And yeah, this is just one of the added benefits that comes along with that, of having control of the fund and what we do and the relationships we have with our investors for 10, 15 years.
Nice. So getting back to the commercial stuff. So what is your typical loan size? And what's your typical loan size? Let's go there first.
Yeah. So for small balance commercial, to me, that typically means maybe $500K to $2 million.
Okay.
Is where that typically ends up and where we're effective and quick. So that kind of stuff. It could be retail, small office, condo sort of thing. A little bit of multifamily, a little bit of storage.
Right.
That's basically where we come in.
65% leverage generally, right? Depends on the asset, I assume, right? And the opportunity.
Right.
And, but you only cover the cost of acquisition. So let's say, for instance, I have a great deal. I can buy it for $1 million, but I know it's worth 1.8. You're not going to lend me the 1.8. You're going to lend me the $1 million. That's it.
So we're going to lend based on the cost because that makes, that just makes us our life and underwriting way easier.
Sure.
And way quicker. And we don't have to, for example, dig as deep into the income and expenses.
Yeah.
Because we're going to be safe at our 60 or whatever it might work out to be loan to cost.
Right.
And for some people it works and some people it doesn't. Some people are looking to deploy a lot of equity, right? Because they might have gotten paid off on another deal or whatever, maybe, or 1031. 1031, they got to roll X amount of cash and they only need this much of a loan. So all those situations pop up.
Got it. So then how long does it take to fund the loan? I like that.
So we're on a commercial, we're probably averaging about 2 weeks.
Okay, nice.
We don't really need valuations. We do a quick internal valuation, but we do need environmental. So between environmental and title, that's really going to be the determining factor on the time frame. Us internally, we're pretty quick.
Yeah. Well, that's huge too, by the way. For anybody out there listening, if you're getting into hard money, or even private, or even an owner finance type of deal too, it doesn't matter. Always do the due diligence stuff, because eventually you're going to have to go to conventional financing, at least conceivably you would, and they're going to ask for that last stuff. And the last thing you want to do is find out you have a huge environmental issue, and you just wanted to go for a quick close, but you didn't run any environmental, and you realized there used to be a laundromat or something like that, or not a laundromat, but a dry cleaner's right next door or something, and your land's contaminated and all kinds of stuff. We always do. We have used owner financing previously for other deals, and we always do the full bug as if we're buying it with lender money too. So always,
that's smart.
Always do that. Always do that, because you never know. You just never know. So good. 2 weeks is very, very quick. That's great, because that's another value add that you can present to someone you're going to deal with. It's like I can close in like 3 weeks. You always have a little buffer in there just in case. It's a good idea to have that, and that's super. So. And typically, what is the hold time then? Like, how long do I keep this loan in place? Because I know it's only good for acquisition, so it's kind of like this sounds to me like this is a case where I need a fast close. My conventional lender is not showing up to the table for whatever reason. I got to find another lender. I come to you guys. You guys shut it down in 2 weeks. I might be able to hang on to it, at least cash flow it for maybe a few months, and then but at that point I'm trying to get you guys out. Right? Is that generally how it goes?
That's generally the game plan. We'll write notes for either 12 or 24 months. But with something like that, the average life of the loan is probably 6 or 7 months. Typically takes longer than you plan for. Everyone's like, oh, we'll pay you off in 3 months. And we're like, cool. Just, bank financing and everything else and lease up and whatever it may be, could slow that down. But you're right. Yeah, like our borrower clients, they want to get in and out of our more expensive money and into the cheaper money, move on with their project as quick as they can. Average probably 6 months. Yeah,
that sounds about right too. Because there's deals that we do, and I can already tell you right now, by the time we ever get into a bridge, Yeah, usually it just takes 30 days to find another lender. And then by the time that lender really understands what the deal is, you're looking at another 60 days just to get it closed at best. Back a year ago, now it's more like, 90 days to get it closed. So yeah, it's about right. Yeah, absolutely.
Yeah.
So
no, it's been a great niche.
Yeah, it's
really no complaints.
Yeah, and I mean, I know that, like I said earlier, it sounds like there's this negative aura around it, but there's always a time, there's always a place for using this type of money to get a deal done. And I think it can also give you a competitive advantage if the deal is that good. I think that's the key, right? That is the key. Any plans of expanding beyond your current market?
So, no firm plans. We have a couple different business partners that came on with us some years ago, which is why we were able to expand outside of like DC Metro. Beyond that, nothing very firm. We do run a mastermind group of other private lenders like us. And so there's always talk about teaming up on deals in different markets and maybe we could deploy with them or what have you, but no real firm plans. No real firm plans quite yet. I mean, there's a lot to do in the Mid-Atlantic. Like we could tack on another, 10 or 20 mil in our market. Without needing to expand geographically.
Right. Yeah. And I think that just to your point earlier, there are plenty of those cash flow and appreciating markets. I can still get nice returns overall because your current footprint is big enough, right? Because if you're in just one single market, you'll be able to enjoy, like, say, one of those types of scenarios, and
right.
Each has their own pluses and minuses, right? So.
Absolutely.
Yeah. So good. So I know we covered a lot of stuff here today. For someone that's listening, maybe they're thinking about getting into a hard money loan for a deal that they're eyeing up. What sort of bulletproof advice would you have for someone listening right now?
So for real estate investing in general, I would advise to go as deep as you can on what you're best at for an extended period of time. And that could be in, you might be new or you might be midterm or what have you, but to go as deep as you can in that niche before expanding outside of it. And that doesn't mean you can't do it. You can't expand into, say, different asset classes. Just because you're a single family investor doesn't mean you can't eventually buy multifamily. I would just advise going as deep as you can into what you're good at first, and then possibly adding to it in the right way with the right homework and due diligence, and play it for the long term. Play the long game, not the cash grab. There's people who are exiting the market in all different niches right now because of that cash grab, right?
Yeah.
And that's not a long-term sustainable model. So you can take that advice, which I hope to be bulletproof, and apply it to whatever you're doing within real estate. And I think it's going to be pretty solid.
No, I think that is bulletproof advice. I think many folks out there, they get the shiny object syndrome, and it's sometimes best to just stick to what you're good at. I think it's great, and just expand it out and hire in the right people to help you maintain and grow it, and then you can focus on something else. That is the right way to do it. If it's not cash flowing properly, then maybe it requires more of your attention. Probably what it is, right? All right. Well,
great stuff.
Yeah. Well, guys, if you want to reach out to Chris, you can reach him via his website at hardmoneybankers.com. Hope you got some insight on hard money lending and how it works and the type of conditions that you'll probably see if you do decide to get into some hard money. Again, strongly recommend it. Don't worry about the negative stigma. It's definitely a great way to get into deals, especially in today's turbulent market. Thanks for tuning in, guys. I'll see you next episode.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.